Fed cuts interest rates at the end of 2025 and outlook for the next move. Following a two-day meeting of the Federal Open Market Committee, FOMC, the U.S. Federal Reserve, Fed, decided to cut interest rates by 25 basis points, bringing the federal funds rate to a range of 3.5 to 3.75%. This marks the third rate cut within 4 months, representing an important turning point in the Fed's current monetary policy cycle and opening the door to more favorable borrowing conditions for U.S. consumers and businesses. Why did the Fed continue cutting rates? In its official statement, the FOMC noted that recent economic data show economic activity continues to expand at a moderate pace. Job growth has slowed in 2025. The unemployment rate has edged slightly higher as of September. Inflationary pressures continue to ease, though not yet fully back to target. Against this backdrop, the Fed chose to lower interest rates by another 0.25 percentage points to support the economy, while emphasizing that future policy decisions will depend closely on incoming economic data, growth prospects, and potential risks. The Fed reaffirmed its commitment to bringing inflation back to its 2% target while avoiding unnecessary pressure on economic growth. Impact on households and the U.S. economy. With interest rates falling to their lowest level in more than 3 years, the move is expected to lower mortgage rates, auto loan rates, and consumer credit costs, create more favorable conditions for business investment and hiring, support consumer spending, particularly during the year-end shopping season. Analysts suggest this decision could serve as a boost to consumer demand as the U.S. economy looks for additional growth momentum. The Fed's latest economic projections. Alongside the rate cut, the Fed updated its economic outlook. U.S. GDP growth next year is projected at 2.3%, up from the previous forecast of 1.8%. PCE inflation, the Fed's preferred inflation gauge, is expected to decline to 2.4%. The unemployment rate is projected at 4.4%. These projections indicate that the Fed views the U.S. economy as relatively stable despite ongoing uncertainties. What will the Fed do in the January 2026 meeting? The Fed is widely expected to hold interest rates steady at its first meeting of 2026. According to data from LSEG, markets currently assign about a 78% probability that rates will remain unchanged. Observers believe the Fed may adopt a cut-and-pause strategy, similar to the approach used by Chair Jerome Powell in 2019. This would allow policymakers time to assess inflation trends in the coming months, developments in the U.S. labor market, the impact of new import tariff policies on prices and supply chains. Market reaction. Following the Fed's announcement, the Dow Jones Industrial Average rose about 0.6%. The S&P 500 gained 0.3%. The Nasdaq Composite was nearly flat. Spot gold prices increased to around $4,213 USD per ounce. Overall, markets responded positively to the decision while remaining cautious about the policy outlook for 2026. How do Fed interest rates affect daily life? The federal funds rate is the benchmark rate for overnight interbank lending, not the rate directly paid by consumers or businesses. However, it strongly influences mortgage and auto loan interest rates, credit card rates, savings and deposit rates. When interest rates decline, borrowing costs fall, encouraging spending and investment. At the same time, savings become less attractive, prompting more money to flow back into the economy. Conclusion. The Fed's consecutive rate cuts at the end of 2025 highlight its effort to balance economic support with inflation control. However, 2026 is likely to be a pause and observe period as policymakers evaluate economic data before making further decisions.